All right, welcome back. Uchenna Minnis, the managing partner at Howard Minnis Asset Management, is joining me right now. Hello, Uchenna. Welcome to the show.
Hi, Naruto. Thank you for having me.
Good. Good to have you too. Let's get started. I would like to know what your views are, first of all, concerning the inflation print that came out last week from the National Bureau of Statistics, showing that headline inflation stands at 19.6% as of July of 2022.
I mean, it was almost like a very clear trajectory as to regards that print. I mean, what we saw in July with the exchange rate and how significant the naira value sort of depreciated. There was that expectation that this would translate into prices of goods and services, and that's what we've seen in the headline inflation. But yes, it was as a result of that significant dive, in the naira against foreign currency, in this case, the USD, and that just translated across board in terms of inflation. That's what we saw.
Uchenna, inflation is not really about, it's not just about higher prices, but about squeezing of people's income. How squeezed do you think people's incomes are right now? To what headroom do people really have headrooms right now?
No, no, this is very aggressive, right? At the moment, purchasing power, as you correctly mentioned, has reduced significantly. In short, when you look at this inflationary print, what that translates to the average Nigerian home is that the number of people can afford to buy things that they would normally buy. So what they do is they probably start to adjust, try to get to a point where they just have to they are now poor, in summary. So there is no quick fix to this, really. That's the truth, given the fact that from a microeconomical standpoint, we're still significantly behind the curve. There are too many deficits we need to deal with at the same time, and that in itself is continually affecting us. So there is no good news, as it were, or I'll put it. There's no light at the end of the tunnel in this immediate term for the average Nigerian, because now a lot of people are now poor.
Okay, if we take a look at this high inflation, how do you think is weighing in on consumer demand? Really, are you seeing a squeeze in consumer demand? Are Nigerians eating less? Are Nigerians not going for wants anymore? Because anyway, even from the analysis, from the numbers, you would know that Nigerians really go for needs and not wants at this time, because close to 60% of what we make as incomes really go for food and some other things. So there's really not a significant space there to go for want. So how constricted is consumer demand?
Yeah, I mean, still emphasizing on what I mentioned, that has eaten deep into the average Nigerian pocket. So there is a squeeze significantly, and we don't know how long this would be for. And that's what I'm saying, that when you go back and you look at, for me, very holistic view to say, okay, what are the plans to curb this inflationary pressure? There's no immediate plan. We right now. It's just speedballing. We don't exactly know what monetary policy stance would be implemented to curb this at the moment, but we are in a critical place. And what we're seeing is, yes, Nigerians would struggle to eat. Nigerians would focus more on needs, and even that need, that bracket in itself would also be squeezed. So you will not prioritize your need list, to say, okay, which is more needed compared to which is less needed. So let's go for the more needy ones before we can afford to the less needed ones. So that's what we'll be seeing. And if you even have just random conversations with people, that would let you know that, I mean, the things I've bought last week or a month ago at this price is doubling down. You consider in your everyday life, it translates to everything around us at the moment. And given the fact that we are significantly dependent on importation as regards to production and even food, in itself, we will be struggling.
Do you see the last two MPC meetings remaining for the year? Do you see rate hikes? Then we'll take investing during inflation from there. Do you see any rate hikes come in September and come November, perhaps, to tame this? And do you also think that the central bank has successfully, apparently not, because inflation numbers are still going up, but in a bid to fight this inflation, do you see a couple of more rate hikes? That's two more rate hikes for the year?
Yeah, without a doubt. And for me, when it comes to the Nigerian monetary policies, I already have an idea on how they intend to move. So aside the inflationary pressure that we're currently facing, they don't really have so much of an option because all of their counterparts that we base our currency against are all significantly increasing rate hikes. You know, we can see G7 countries significantly increasing their rates. So we don't have an option. We have to follow suit, you know, and that's what's going to be the case for us, really. There'll be rate hikes. I know we would have two more rate hikes going into the end of the year, but I'm not really so bothered about rate hiking. Really, my worry is what are the other plans? What are how can they tighten monetary policies at the same time enhance and make the environment more enabling for the average Nigerian. You know, what I'm concerned is what's their focus really in terms of the unconventional monetary policies that they can use as tools to sort of cope this inflationary pressure. Not the rate hike. The rate hike is conventional. Yes, it would have is effect on the economy, but
So, sorry.
you would expect I need to see what they would do aside rate hiking.
Okay, so that takes me to the question of inflation right now, which is at 19.6%. Where do you think we should put our money? Where should you put your money right now? Or does it also depend on how much money you have?
So I mean, see, it is when it comes to investment vehicles, especially here, right, localized investment vehicles, at this point in time, you find out that a lot of uh, 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 vehicles, basically asset classes, are underperforming when you compared to the inflationary pressure. So when you now take the net rate, the real rate on in itself of what your yield is, you realize that you're in deficit. You know, when you actually compare these rates, given where we are, 19.84%. So for me, your focus right now is to have a hybrid. Say you go into cash equivalents, look for mutual funds. Basically they try to create a portfolio that sort of is a hybrid as to the securities that they put in the portfolio so that they can sort of try to return at the point close to inflationary pressure. But on the average, what you see on the mutual funds are between 10, 12%, and we are already at 19. Another thing people have come to do really is to convert their naira into USD and just hold. You know, in itself, that is an investment, given the fact that, I mean, 4 or 5 months ago, we were trading somewhere around 400. Now we're about what? Maybe going to net close to 700, you know. So when you compare that return, that in itself is about 10, 11%. So people are doing that, but you can't necessarily advise on that, given the fact that there is no there is no clear, stable should I say, graphing as to where this rate will go. And I can tell you now we are at the top when it comes to the FX exchange. There's possibility it trades lower, then trades higher again. So there's too many variables when it comes to that, but a number of people are doing that. So what people have done is convert their naira into USD, then look for dollar-based investments, you know, and that's what people are looking to do. But generally speaking, I would say have a hybrid. Try to go into cash equivalents, and possibly also look at the stock market. Yes, it's not as beautiful compared to what he did last year, or in even the year pandemic. But however, it's still trading in a place where you can see some level of returns really.
Uchenna, I would like you to really expatiate when you talk about cash equivalent. What do you really mean by that? Then I would also like you to break down when you mentioned the stock market. Which categories of equities should one really take a look at now to preserve your wealth or to preserve your cash?
Yeah. So when I mean when I'm sorry when I mean cash equivalents, I'm just talking about liquid easy liquidating assets. When you have money in mutual funds, for example, that you can really get in and get out. FGN bonds too. In that regards to you have the short term ones. These are things that you can always put your money in because of the tenure and the flexibility of you going in and out. So it's just you saying, okay, you know what, I'm just going to have my money there, or even your savings account. When you put your money there's some return you get. But when you look see it, people just don't focus on it. But that is a play. That's really a play. You can have that. Those are what we can categorize as cash and cash equivalents, really. But when I was talking about the stock market, the financials, the banking sector really are always, as I've mentioned to you earlier before, in a way they're sort of defensive, and that's given the fact that the sector has actually been fortified by the regulators, Central Bank, and also Security Exchange Commission. So that way, there is that high level of comfort that there is no room for failure. At the end of the day, they have. They stick to the guidelines, and they will always return positive, especially when it comes to the tier one banks. I wouldn't say the oil and gas sector is the place you want to really go in now, and the reason is very weird, because this is supposed to be the best time for you to put money in oil and gas sectors. But because of our dynamics and how we are, in a way, so dependent on re-importing what we've exported, there is that net negative effect, really. When you compare to our counterparts, you can see them returning significant value, given the fact that, based on the Russia-Ukraine war, oil prices have traded significantly higher, and on the basis of that, they've really been able to get profitable margin. But that has had a detrimental effect to us, because at the end of the day, our exchange rate is so high, and when we import in, we import with that FX. So that's basically where what the issue is with our oil and gas sector. But I can say the agricultural sector too is a place you can always look at. But banking sectors the equities are really going to be, they're just fortified against whatever we currently face in the country, given the fact that there is always a strong indication that nothing drastic can go wrong.
Okay, so what I can actually deduce from what you're saying around the capital market now should be, at this time, perhaps investors, or if you want to preserve your wealth, you should be going for the non-cyclical stocks, the non-cyclicals, equities right now, equities that may not really be affected by the economic fundamentals like consumables and all of that. Is that what you're saying? So
Yeah.
invest in those kind
Yeah,
of
yeah,
companies.
perfectly. Yes, so non-cyclical stocks, basically. In a way, the way it has been structured is, they operate in their own bubble because of how they are set up, and the dynamics in which they've made the environment very enabling for them, and that's it.
Okay. Don't you think that the current macroeconomic situation in the country would also affect those companies? For example, the companies around the FCMG, food and consumer goods sector. You can imagine what the cost of doing business will be for them right now. Let me just quote an example, like for DAC Communications, AIT, where we are right now. In fact, I was told by one of the directors, was it last week or 2 weeks ago, that AIT spends about 36 million in buying diesel, I think, and that will be used like in a month or in less than a month. 36 million naira, which wasn't like that before. So if you take a look at the companies within that food, consumer goods and beverage and what have you, their cost of production and the cost of doing business is higher. So investing in non-cyclicals now, does it really make sense? Because I understand what you said, they are defensive, but would they be paying lesser dividends? How much can we get capital appreciation if you want to play capital appreciation in the market? Uchenna, I know you understand what I'm saying.
Yes, I do. I do. I mean, but yeah, it's you've made a valid point, but when you look at it, it still boils down to who the consumers are. At the end of the day, these costs are actually being transferred down, and it gets to a point where people start to manage the situation. But it's you, it's me that would want to pay for these things, and now we can't afford it, or because of the fact that something that cost maybe 1,000 naira now is now costing 1,500 or 1,800. So it's the consumers at the end of the day that get the short end of the sticks. The corporates adjust their profit margin. As you also said, they, in terms of capital structuring, they might have more retained earnings, put it back into the business. And because there is a structure in place, all they just need to do is adjust their P&Ls, adjust their margins, and translate it to whoever it is that will be paying for it at the end of the day. And when you say, oh, like for the diesel consumption now, your company needs to use diesel. I mean, you can't have this without paying for diesel. What happens is that the cost now increases to the very person that buys the product. At the end of the day, now it doesn't necessarily change the fact that you need to use this product. You have to use it because they are essentials, really. But what we are saying, as you mentioned, is the macro situation is so key that it needs to actually be worked on. And what the issues here, Nancy, just for them having just refineries, really. When it comes to the oil and gas, having 2 or 3 functioning refineries keeps us in a very comfortable place. It's not going to be the perfect or the Hail Mary solution, but it keeps us in a very comfortable place whereby we can curb inflationary pressure. We can have just exponential surge in inflationary pressure and out of the blues, that's what we're currently facing. Yes, a number of companies would face the hit. However, because there is a structure on ground, they can play around with the margin. But at the end of the day, because they provide essential services, the FCMG people, and we need to buy these things to feed, it is the average person that needs to purchase it. And as we said earlier on, you now need to pay more for the same value.
So, are there other avenues whereby we can actually preserve or protect our monies at this time? Okay, let me talk about the banks a little bit, because the Central Bank of Nigeria just reviewed the savings deposit rate from 1.4%, that is 10% of MPR, to about 30% of MPR, which is deposit rate now should be about 4.2%. If you take a look at that, is it anything encouraging, bearing in mind that inflation is at 19.6%? So even whatever it is, you're already having a negative interest rate.
Yeah, I mean, I mentioned earlier, when you look at the real rates, you're in negative, and a lot of investment vehicles are like that. But you need to ask yourself, what are your alternatives, really? You have your cash with you. I mean, it's not earning anything. You are still going to be exposed to the 19%, irrespective when you want to pay. However, when you have your monies at the point where you are making four, there is a net negative, and that's why I suggested that it has to be a hybrid. You need to be able to tell yourself, okay, you know what, I'm doing 80% of my portfolio in cash and cash equivalent, like what you just mentioned with the savings, or FGM bonds, any of this in security. And you can say, okay, you know what, 20% will be more aggressive. Let's go for things that can return significantly higher. As I've mentioned, you can go into equity stocks and be very aggressive with your trade. Now, when you average down the rates, you will find out that say your trade on the equity side or the risky side is comes back positive, you'll probably be getting maybe a 20 or 25% thereabout. When you average that, you can still see that your hybrid will trade higher than the inflationary rate. But you just cannot do the conventional way of investing now, the traditional way of investing. You would lose money. I
And
mean,
what
not physically, but in terms of inflation.
and what is the
Inflation.
traditional way? What do you mean by the traditional way?
Say that again.
What do you mean by the traditional way? You just mentioned the traditional way. You shouldn't invest the traditional way. What do you mean by that?
Yeah, traditional way is people just being very conservative, go into the fixed income space, buy their bonds, buy their treasury bills, and just wait it out. It's government backed, it's secured and whatnot. But I mean, at the end of the day, you're coming back negative. At the time when you have access to your funds, your inflationary pressure has literally eaten in terms of that real yield. So what I said is, in context now, what I mean is the non-traditional ways you're creating a hybrid structure for your investing, whereby you can take a smaller percentage of your funds and be very aggressive in your investment dynamics.
So let's talk about commodities. Earlier on, before you came up, when I was analyzing the commodities, gold assets, what do you think about that? Because you see that even a lot of women have gold now, even some guys do. Is it really a way to protect your cash at this point? Because an ounce of gold is really expensive right now.
Yeah, yeah. Precious metals are actually underperforming given analysis of what we're looking at the beginning of the year, and the reason is that we are having a significant surge in dollar prices. And when you look at that, you realize that has sort of reduced the purchasing power in these commodities, but gold, precious metal, silver, they are long-term plays, and I can tell you categorically that in the next 3, 5, 6 years, you would literally be looking at almost a 30, 40% one, in my opinion. On the base, because it's from when you look at the chart from a technical point of view, they are actually in a bullish run, but because we are in this place where there is a I mean, we're coming out from a pandemic. There was a global inflationary problem, and the dollar is sort of just coming out into life in terms of its bullish run. That has sort of just paced it. But if you have those risk capital and you are patient and patient funding, or you want to go to a patient investment horizon, then yes, you're okay buying gold. I can almost tell you that it's a safe place to keep your funds at the moment, at least for a while. But when you're looking for quick returns, maybe within a short time space, 6 months to a year, you might not get that value for what you're looking for in terms of yield. It's a longer term play, Nancy.
Uchenna, I also need us to, put a caveat emptor there in terms of, for those that are looking for quick returns, we are not talking about doubling money, or the MMM types, or the bring 50,000 today, I'm going to double it 100,000 the day after tomorrow. So I really need you to speak about that, because within this period, you're also seeing that there is a growth of fraudulent schemes and scams taking money from people to tell them, oh, let's protect your cash and let's preserve your cash. So what should Nigerians be looking out for now?
Nigeria. So, and you're right, actually, because at this point in time, these breeds for people to take advantage of such the loopholes and say, well, we can do this. The country is struggling, but we can help you do this. I mean, is and I can tell you at every point in time, 99% of it is a Ponzi scheme. It's fraudulent, and the reason is that when you start to break down their underlying model. Some of them that might even have the right intention, they just don't plan for what it is, the infrastructure that they currently have. And I will use an example for the agri crowdfunding guys. At the very, very base, they started up well. The infrastructure could accommodate a certain amount of inflow, but when you look at things they go all out and market in a way that structure is infallible. what happens is they get this money and they don't have the infrastructure to match what they've gotten, and that's what happens to, and they just find themselves in positive schemes. See, the fact is, there's no quick way to make money, and that's the truth. You have to. There is. It requires work, and when it requires work, you realize that there is a reason why the best of the best fund managers will tell you that in a very beautiful, wonderful year, they return 36%, net, and that is, I mean, extreme. Conservatively, people are still telling you that yes, we've just beaten inflation. Inflation in the country is about 4%, and we're returning 8.5 to you. And that's because of the fact that there is no foolproof, because when you go into that investment dynamics, there's the ups and downs. So there's a net wise that is
Yeah.
coming out as 8%. So that's just it. People need to understand that there are no.
Okay. Thank thank you, Che, for your thoughts. So much insights there. The really the cocoa of what we're saying is that protecting your cash, making more money takes work and time as well as patience. Thank you very much, Uche. I've been speaking with Uchenna Minnis, the managing partner at Howard Minnis Asset Management. We will be with you again, same time tomorrow. I am Nancy Najibi, the best you can be, and be that change that you want to see. Bye now.